Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here is your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. A limited move higher as the market ran up into a weird area of congestion overhead made up from the 2010 to 2014 irregular head and shoulders top neckline, currently at 1615, and the March to June 2021 bearish bump and run reversal trendline extension, currently at 1632. Actually, this was something I warned about last week. The outcome was a combined outside day and bearish harami last Thursday, and a more vengeful key reversal down and bearish engulfing pattern this past Monday. Now, though we saw a follow through lower after Monday's action, it was limited and was halted by the very light congestion from 2 weeks ago in the 1547 to 1550 area. Interestingly, the congestion which acted as a base last week, namely the 1571 to 1578 area, contained a November 2012 high at 1571 and the June 2021 high at 1577. Well, it has so far failed to participate in this week, including the move back up. Meanwhile, looking below, we have as the first point of significant contact the extension of the upper channel line of the halfway hesitation, currently at 1495. This seems reasonable, at least for now. Overall, there is the beginnings of a big question that may soon be posed. Is the action from the 2021 high in May at 1667, as it is one that's following on, and if it is, which one would it be? There are right now three possibilities: a rounded bottom, a large cup with a handle pattern, or a scallop pattern. This may well be the most interesting thing to find out in the coming weeks. Chicago soybean meal. The key feature here for now many weeks, and one that has been in effect since late November 2021, is the October to November 2021 bullish Andrews pitchfork. The upper tine, currently at 479.90, had and has capped the market throughout, with the middle tine, currently 454.30, acting as both support and resistance, and today as resistance. And then the lower tine, currently at 428.80, acting as support, but getting broken during late January. So why have I still kept this broken Andrews pitchfork on my daily chart after its evident break? Well, when the lower tine was broken, just below at the time was the 50% Fibonacci line for the whole of 2021 at 390.40 at the time. And it was this that stopped a full exploitation of the break lower and indeed turned the market back up, back into this now broken but still effective bullish Andrews pitchfork. The move higher 4 weeks ago also allowed me the opportunity to draw a fresh new bullish Andrews pitchfork for the late November 2021 to late January 2022 action, which is at a slightly steeper angle of attack. 2 weeks ago, prices moved up and over the previous early January high, hesitated for a bit at the crossover of both middle tines before gapping higher over the weekend and making a new high last Thursday, not seen since May 2014. However, this big move up last Thursday was also its undoing, as the market formed a combined key reversal down and bearish engulfing pattern that day, which then followed through lower until yesterday. Yesterday saw a combined key reversal up and bullish engulfing pattern. So that the question now is this a halt and return higher from the combined highs and congestion from January, February and early April 2021, or is it just a pause before we try once more to break the two lower tines? Well, so far today, the market is unsure and hesitant about it. Two final points. I've had target X in the 475 even area marked for a few weeks now. This is the target derived from looking at the action since late November last year as a bullish halfway hesitation. It is not a perfect target, however. This market has had some pedigree in this, as it formed a similar, if smaller, pattern between mid-October and late December last year. Well, last week's high was 474.90, and I reckon I can call that target X has been reached. I finish on a point I spoke about last week that has come about last Friday. It is a lagging indicator, but the rising medium moving average, currently 373.10, made a golden cross over the slower rising long moving average, currently 369.40. Chicago soybean oil. The recent major feature here has been and still is the mid-December to date bull channels. The original and narrower of the two, currently 68.91 to 70.46, worked well until early January, when the market expanded to a larger bull channel. It reasserted itself between mid-January until 2 weeks ago, when the market once again expanded to the larger bull channel. I've kept the original broken lower bull channel line on the daily chart because, as the market utilized it twice already, it would seem reasonable to hold it near just in case. The newer, wider bull channel still utilizes the upper bull channel line, currently at 70.46, but has a wider and lower bull channel line below, currently 64.56. This lower bull channel line was verified as recently as last week. Now, we've not had any other major patterns operational at this time apart from these two bull channels, though I was and still am mindful I could draw bullish Andrews and shift pitchforks for the action since December last year. However, I choose not to, as these would be very narrow pitchforks and likely of limited use, perhaps only good for timing, and with nothing really better to offer than what the two current bull channels can offer now. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.